Just looking at the current rate, we're sitting at around 6%. Inflation ticking up for the month of December. We're sitting at around 4.5%. Your view on what could play out today? Some are saying that we might see a 25 basis point rate hike.
Thank you very much. I think an interesting place to start in analyzing what is likely to be the outcome of the MPC meeting is really what they said at their last meeting. The concern and the dominant theme of the central bank's intervention for the last year or so has really been supporting what was a fragile economic recovery. In my own view, I don't think the recovery is such that they would be able to begin to focus on other perennial concerns such as interest rates and inflation. So I think you will find that the various fundamental factors at this point in time would argue for them holding the rate. And while there may be some chance that they would increase it, I think that would go against the current trend. And I don't think there's enough information in the market at the moment to warrant a reversal in policy.
It's quite interesting. I mean, looking at the food aspect and components of the inflation basket, and I think on a global level as well, a lot of concern that food prices have rallied around 13% last year. Do you think that this is going to filter through into Kenya? And I suppose it also has to do with what kind of scenario is going to play out with the weather as well.
And that's very true. I mean, for much of last year, we've had much better rainfall than we've had over the last 2 to 3 years, and it was much more reliable, and it did confound the expectations for weather. Already we're seeing the weatherman predicting that the first half of this year at least will see us receive suboptimal rainfall, and that does become a concern then, because we are an agricultural economy and the price of food is a big component of the food basket, of the basket of goods that are used to measure inflation. So I think if that situation persists, I think then, yes, inflation may become a greater concern, but I think for the moment, there just isn't enough certainty about whether or not food prices will continue to skyrocket to the extent that they would begin to skew the inflation measurement for the economy.
Let's look at it from a bond perspective as well, because bond yields started falling in December. We keep talking about an expansionary policy coming to the fore by the central bank. How do you see the bond market perhaps giving some form of direction on the interest rate front, if at all, in Kenya?
Really, the bond market has been a microcosm of the whole interest rate analysis within the economy. One thing that has bothered the central bank for a long time is that while shorter-term interest rates, and here we talk about treasury bills and the shorter-term money, have come down, the bond rates and the yield curve have been largely unaffected by what the central bank has been trying to do, and the access of ease to credit within the wider economy has also been unaffected. I think already we're seeing bond rates tick up, as you point out, and I just think really the central bank's concern in a meeting like today's will be about how they can address their longer-term goal, which is about easing the access of credit within the economy and having banks lend more. And I think you'll really see bonds react relatively little, because as it is, the rates have come low over the past time because of what the central bank has been doing. But the concern really has been about the ease of access to credit within the wider economy rather than the bond rates themselves, which have allowed the banks and the government to continue to borrow relatively cheaply from the economy.
It also we see one other trend that comes to the fore, that banks also give a lot of direction when it comes to the interest rate environment. We have seen banks started to relax lending rates, particularly in 2010, perhaps trying to spur some credit demand as well. What role will they play going forward?
I think there's a big tug of war going on between the central bank and the commercial banking sector. For a long time, the central bank has emphasized that we need to expand the availability of credit within the economy if this economy is to grow. I think the central bank was almost running out of ideas towards the end of 2010 about how exactly they could transmit their lower interest rate signal to the commercial banking sector. I think now that they have a time to come back and review the effect of their lower interest rates over the whole economy, I think they'll be thinking about new transmission mechanisms that can prompt banks to lower their rates even further, because even though rates have come down, the interest rate spread is still quite big and is limiting the economic recovery and growth of Kenya.